Before we begin, please note that this video contains AI-generated visualizations, is strictly for educational purposes, and is not financial advice. If you have 1 lakh rupees to invest, you face an immediate choice. You can buy a single share of a massive company like MRF, or buy 1,000 shares of a smaller company for 100 rupees each. Most new investors instinctively reach for the 1,000 smaller shares. Holding a larger quantity of stock simply feels like a better bargain. But chasing these visually cheap penny stocks often leads to disaster. Without a strict stop-loss, portfolios built entirely on low-priced shares regularly see 60 to 90% of their capital wiped out by sudden volatility. The standalone price of a single share tells you absolutely nothing about the company's financial foundation, its total size, or its actual market value. The pursuit of a cheap share price is an illusion that actively destroys retail wealth. Track a 1 lakh rupee investment in 2 scenarios, a single expensive share versus 1,000 cheap shares. If both experience 30% growth, the result is identical. Both return exactly 30,000 rupees. Share quality is completely irrelevant to your return. To evaluate a company, you have to look at its market capitalization. This is calculated by taking the total number of existing shares and multiplying them by the current market value of a single share. Market cap is the only reliable mathematical formula to determine a company's true scale and worth on the exchange. You can use market cap to categorize listed companies into 3 distinct risk tiers, forming a market mountain. The solid base of this mountain is made up of large cap companies, the top 100 ranked by market capitalization. Blue chip companies move slowly, offering steady returns with very low risk and reliably paying out dividends. Moving up the slope, we find the mid-cap companies, ranking from 101 to 250. Mid-caps offer high growth potential, but the terrain is highly volatile, with prices swinging rapidly. At the jagged peaks are the small caps and micro caps. The risk here is severe. Any minor issue can send a company collapsing. Long-term survival requires knowing exactly which tier of the mountain your money is parked on, and ensuring that your risk tolerance matches the terrain. Once you understand market cap, the final ingredient to wealth creation is time. Massive wealth is built through the slow power of compounding over decades. Look at Eicher Motors. Over 3 decades, a seemingly insignificant 1 rupee investment transformed into millions, entirely because the stock was held long-term. You see this exact same principle in Warren Buffett's long investment trajectory. Buffett generated 80% of his massive wealth after he turned 60 years old. Real wealth demands decades of patience, not frantic daily trading. Long-term value investing requires identifying the specific economic shifts and the emerging technologies that will clearly and definitively define tomorrow. Over the next decade, massive capital will flow into completely new infrastructure, including renewable energy grids, advanced battery tech, and high-tech waste recycling. Smart capital is already taking positions in these spaces. High-profile investors like Sachin Tendulkar are currently backing early-stage semiconductor startups. The most effective portfolio strategy combines these elements. Build an unshakable foundation with large caps, and place calculated long-term bets on the companies building tomorrow's infrastructure. Never buy a share simply because the price tag looks cheap. Investor capital based on the company's true mathematical scale and its actual potential to shape the future.